Hi, is anyone there? Or do I need to re-announce it? We're back. It's mad. Sorry we missed Monday, power cut, blah, 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 load of rubbish. We're back in town. Bletchley's here. Hi, Bletchley. Good to see you. I think I need to re-announce the what's it. Lee Young, voice is a little low. I'll check that out. Right, that should be better. I think we're up and running. Right, yeah, all good to go. Right, how is everyone? Are you all surviving? A tad tricky. Thought we might have wave 4 pullbacks, but it's crazy. You've got some things that might actually be wave 2s. I don't think they're necessarily going to crash, although there is a good story for end of the world, which we can go through. Obviously, I didn't get to speak to you on Monday. So I'll kind of start the week, go through that unless you've got any questions, and then just where we are, etc. A few thoughts on a few of the markets that have probably done enough to at least bounce for a short while, even if there's another low to come. But at the moment, I was sort of trying to second guess what the end of the carry trade is. 50 to 60% of open interest in UJ has disappeared, which is why people are saying it's pretty advanced. If anything, people might start to put that back on. What is strange and what I've talked about today was people are still concentrating on the Japanese side of things for the carry trade. This was all done, although they did the right thing, moving 50 bits, 15 bits, 1.5, the JGB quicker than, so they're all positives that we needed to hear from them. But what blew this up was a bigger than expected perception of recession odds in the States, Fed behind the curve, everyone shouting for 50 basis points immediately. JP and Citi saying 50 at September and November, etc. And if you're going to normalise, and everyone's now saying Fed behind the curve, if they normal rates, and take the 2.5% inflation off 5.5%, then you should be down at 3. 2.5% off gets you back to sort of pre-COVID levels. And if you do that, where does UJ go? That goes to 100. That's where they were pre-COVID. So going from 150 to 100, a third off, you're going to get absolutely buried in carry trades. So hence, it was an immediate get me out at any price. That's why they're price agnostic when they're hedging, etc., etc. And I think the narrative has to remain around that macro top down. Really, so we've got to get through this period of the Fed not even looking at things. Yes, Kwang Chu, how important is Jackson Hole? why was it invented? It's kind of their summer recess. I think it used to have a different name. Can't remember what it was. Maybe it's because they were at some other venue. But yeah, Jackson Hole over the last few years is definitely where it is. They're not supposed to announce interest rates, but they've had a habit over the years of announcing changes in policy. They do a kind of review of where things are, what they're kind of thinking over summer, and often they use it, which is a potential reason why they've not done an inter-meeting cut, because if they're going to introduce it, it's an event. But don't rule out if we get a series of bad data that go away from programme. No October meeting either. How old am I? I think I'm 52. Yeah, 53. Does that matter? Do I trade the Flying Unicorn? What's the Flying Unicorn model? Is that like what Edward does with his, what do you call it? The mermaid tail, all that. Younger goat boss. So yeah, it's all about near term what we're having, and if you look at the Atlanta Fed Q3, etc., even going through the ISM non-farm payrolls, it only pulled back to 2.5% for GDP, and the data on trade and ISM services since have shot it back up to 2.9. So there isn't a particular underlying panic in the models. Everyone's going, the SARM rule has been initiated. Remember, we've looked at that from the 12-month low once the 3-month moving average moves 0.5% away from that low. It's had a 9 out of 9 100% record of happening ahead of a recession. But even the girl who created that rule, Claudia Salm said, and she's an economist that used to work at the Fed, it's all about direction of travel. She thinks it's still likely that there's a recession. What it does is capture the trend. It's not necessarily a sell rule. So she herself said, be calm. Is coming off a strange background with all the QE, etc., of having clouded the issue. But obviously, it's her own model. I don't want to totally give up on it, but she's saying it's not 100% definite, even though in the past it has been. So yeah, the media is calling it calm, not SARM. And remember that 4.3% unemployment rate was actually 4.256. So it fell into what we talk about with rounding, which you have to be aware of for making things over and underestimate. And that's exactly what happened. 4.3 scared everyone, and really it's 4.25. Still 0.15 ahead of expectation, but I'm moving in the wrong direction. Remember, 4.2 the unemployment rate the Fed had for the end of next year, and 4% for this year. So they are behind on their own data, despite the fact they're trying to pretend nothing's happening. We knew that we were going into a seasonally soft period. Start of August is poor. It has hit rates of down days, not necessarily historically big ones. Half two of August normally ends up positive overall. But by definition, that means that you can have sell-offs in half one. The Russell is normally always down, which kind of sits with the unwind of the Russell 2000 anyway, and the rotation trade. So a lot of things that were there at the margin telling you, but we potentially, is this bringing forward what normally happens in September? So in the US presidential years, August normally is a big rally, and then all years tend to sell off in September before we get the either election rally or the end of year rally coming on. So there's big questions as to whether we've actually just put a lot of that in, or we're just going to bob around and go sideways. It doesn't stop the rallies and sell-offs being big. We might just be about to go into a sideways pattern for a couple of months, rather than hit all-time highs and then have a big sell-off. We talked about volatility. We'll have a look at that. VIX, etc. We said it was in that down channel. We were worried if it ever got into the 20s again, which which meant it would have to break out of that channel, which we had just tried to get out of that at the end of last week. And then obviously, absolutely crazy VIX print on Monday, up through 60. It's only happened COVID and GFC previously, and then obviously came back yesterday. All that's done is make a lot of option traders very rich. You don't just trade on price in options, you trade on what price it is in terms of volatility. And that if you're trading on a vol market in the 60s, generally you're going to make money. Who've you got there? Prop industry, you've taken your message away. Ubaid, YouTube, love you. Earth Capital. Good. Spread the love. So long vol was the winner, and we'll also have a look. The bond index broke out as well, and that is mainly because of just look at how each part of the curve is moving. I mean, the 2-year yield, which has made the steepening of the curve, again, an indicator which normally precludes going into recession. That's been jumping up and down 25 bips every day. So the volatility in that has gone up. And we'll see that it was reflected in the move, the bond volatility index as well. We still haven't had the punishment from Iran. And the biggest issue that I had going into the start of the week was Goolsby, Super Dove. Now, apparently he sat in on the meeting. He's not a voting member at the moment. He's on the rotation squad in case anyone's missing. Cleveland were missing, so he took their seat. And I think if it had been sat there representing his own state, he'd have probably voted for a cut, but he played the straight back and didn't vote for any change. And then came out and he started talking post the bad data about we can't get carried away. Oh, well, this is confirming his own dovish stance. So really disappointing talking head. We've not had anything much different. Daily came out yesterday, or Monday, wasn't it, and said that it's obviously showing a weakening labour market and that we will be on the way to cuts. But just wouldn't give any quantum or timing. But the market is telling us it's September. It's all whether it's 50, 25 or more. Now, I still think the Fed wants to try and get away with 25. And the reason they're going to want to do that is look at what the impact we just talked about on the carry trade. Overnight, the Bank of Japan have come out and said, and they've obviously realised they don't want to get blamed for all this, that they could have not done anything because they've been trying to wait for the US data to implode. And just ironically, as soon as they move rates, US data implodes. The heavy lifting should get done by US rates, as we've discussed, up to 300 basis points potential. That is what the driver is. And if that's going forward quickly, then you might have more carry trade unwind, although we think a lot of it is out of the way. So, you know what they're like, they're so cautious, they're going to be thinking that a 50 basis point cut and mortgages are potentially enough to trigger another risk off moment. Unlike other parts of the world, apart from China probably, the exposure to trading is, US is the biggest. People trade their pension funds and PA a lot more than in other parts of the world. So investment gains do have a big impact and correlation with consumer spending. And that is the big thing that holds up 80% of the US economy. So they don't really want to do anything that affects that. With people being slightly worried, the 6 to 8 trillion in money funds, a lot of that gets left where it is all the time. The excess is maximum 2 to 3 trillion. That is probably not going to come out to do much if the market is panicking. So there's a big chance that the Fed starts talking about still definitely doing a rate cut, but trying to guide everyone to 25, in which case we'll get a bit of a dollar rally. We have had a move down, expected a bounce. We talked about a bounce in UJ happening. That's continued overnight. So that might be the short-term play. When we have a look at that, there's still a little bit more potential juice as we get into September, and then we'll see what happens if the market and data starts falling down. The dollar is set up still for another big fall after this consolidation. So I don't think the Fed wants to be responsible for any kind of panic inducing. Generally, central banks are supposed to do no harm. Paul Donovan, UBS, commented about that overnight, saying central banks should do no harm, and that's why Japan are suddenly trying to take a step back. They got sort of forced into it by the market. I still think it's the right thing to signal. People can and ah about whether the fundamentals are super strong, but they need to have done what they did because the carry trade was still being pushed against them. People were trying to find where the band broke. Unfortunately, the US broke it for them. So yeah, quite weak data-wise. And obviously, we've had ISM, we've got jobless coming up tomorrow. Earnings-wise, they're at the periphery. I've mentioned 80% of where are we? Yeah, 80% of Q2 for the S&P is done, and the earnings run rate is 12%, which is right at the top end, if not slightly above what we're expecting. The issue we've got is 39 companies, or roughly 10% of the S&P 500, have given negative Q3 guidance, or not necessarily negative, but below the growth rates that were already in there. So slight slowdowns. We need to see how that looks at the margins, but if anything, we've probably put in enough to reflect that into the market, and people are out there shopping. The AI side of things, despite all the hullabaloo about the capex, and the monetization, is coming through. We've had the people below that talks about the service nows, Palantir overnight or over yesterday, and even Supermicro, who is down 13% pre-market. Their revenues beat, the spend is there. Supermicro are getting hit on component costs and the fact that NVIDIA have got a slight delay on the next generation, which is where their super cooling, liquid cooling tech comes through. But the actual at the street revolution for AI that people are trying to tell you that no one's going to use it, the companies, and I've been reviewing a company called Cycle, they're going like banzai. Companies are to clean up their data. I think people like Accenture mentioned that they literally go in and try and get people's data ready to then be able to use AI, etc. ServiceNow, Cycle, they're in there using people's own technology, using internet apps, networking, you name it, to try and learn that process. So they're making efficiency gains, 40 or 50% for people. That is not a win. This is a revolution and will continue. So this really is a buying opportunity, potentially in AI, whether it's now or you have a gin coming back. I don't think the doom monsters are right about AI. Now, the rest of the market, there is a two-way pull on what the economy is doing, and that is why you need to have the bailout of the rates. Rates are too high, they're tight. Global slowdown. Europe has been bobbing along, looking to hopefully break out. The rate cycle there needs to come down, and they're waiting for the US. UK, similarly, nobody wants to get out of line with the US, but we had a chart about actual, and a lot of you know about this as part of the de-dollarization idea. It's becoming ridiculously expensive to service US debt. The economics since the GFC was called US repression. It's called debt repression, and you're supposed to be keeping inflation low, growing slowly so that you can earn your way out of the debt. You can't have, because the debt piles are so big in Japan, US, sort of countries in Europe, you literally can't be servicing it 5% plus. You need those rates steady in the sort of no more than 4% ranges, and that is where they've got to get to, but without panicking. At the moment, they're worried about restoking inflation. I think that is totally wrong. It's now about demand, implosion, employment. When companies are specifically telling you that people aren't buying because of the price, you know that has run out of room. They're going to have to take the margin hits themselves. So there's a little bit of pressure on some of the companies that have been saying how they've been having to adjust how they do price rises and discounting, etc., etc. So inflation is about to come off. And I mentioned it today, the Chinese situation, the trade balance there, whilst it is at a record $99 billion, the reason for exports didn't grow as much as they should have done, or did they? Because they've got deflation in China. Apply that to the relative numbers, and their exports aren't as bad as it seems. And that's mainly because they've got to work their way out of it. They've got absolute stockpiles in 5 out of their 7 manufacturing industries, which represents a quarter of their economy. So they're going to export deflation basically to get rid of that, get some money back in, get their economy growing. Import-wise, that's so important for US exports, European exports, Germany particularly. That's why they're struggling. Those import figures looked all right today, but that wasn't underlying demand. 15% of that was stockpiling semiconductor chips because they know there's potential for an embargo, whoever gets in the US, and oil coming off, and they're stockpiling that, which is something that they normally do into weakness. So take those out, and imports didn't look too good. So global demand from the China perspective isn't really there, and that is flowing through. I still think if they're not careful, there's exported disinflation at a high rate, if not bordering on deflation, if you're not careful, months down the line. They need to start cutting rates. They need to start quickly. They should have started in 25 bips so they didn't have to panic. Now they've got probably needing to do 50 bips just as that is going to reignite carry trades. What's the net of that for trading? That's volatility. Even though it's coming off elevated levels, it's probably going to stay elevated over the next 6 weeks or so as a result. So yeah, China trade struggling. Bank of Japan, we talked about that, earnings. Some people say, if you want to buy these markets, is it like having a 10% voucher off a Birkin handbag? For those who don't know, they're the sort of £10,000 luxury handbags that the Chinese generally buy and have been buying in Japan because of the relative purchasing discount. There's potential for that. As I said, we'll show and have a look at it. I think we're in a trading bounce. There is a chance that we may have another low off the back of that, but if anything, the moves in some of the stock markets are so extreme, they look like they've advanced wave 2 pullbacks, in which case eventually we'll be working our way up on quite aggressive wave 3 breakouts. Ubaid, YT, you want to buy a chance, but you don't have the money, any customer service job available? You need to go and speak on the public chat. Whether you want to move to Newcastle, there's definitely jobs in Newcastle. I don't know whether they've got anything left in online, etc. But certainly worth getting hold of Alex if you can. We obviously are always looking for people with upgrading our processes for KYC and for payout, but we do, last time I spoke to anyone, we did need more people. So there's every chance. So give it a try. And so I delayed this because I was talking to a super bear in the Elliott Wave world yesterday, and he was talking about, he looks at things from the bond perspective, which is something that I started off doing and still like to look at. And you can see on that piece, that page that I'm sharing, the number of issues that they have in the markets. We've all seen it, and we've been showing it. The bond yields have broken down. We'll have a look at what that means. They're going lower, but they're in a sort of corrective wave in terms of the high degrees. So at some point, rates are going to go back up again. But for the moment, they're going down, and for demand reasons or demand inflation, which we just talked about. Nestle, McDonald's, Heineken, Airbnb, lots of the big names. I mean, you can count some of the airlines, Pepsi, etc., saying that there's a lot of trading down going on, demand, sensitivity, elasticity. Whereas when things are good, people are a bit more inelastic. They'll pay up for the things that are in vogue. The people are really coming down. I don't know. I've got no giveaways here at the moment, I'm afraid. That's Maximus. Something that I'm hoping to encourage them to do. But as it is, what they look at is a thing called, they call it the Campbell Soup versus Restaurants Index, a trading down index. So basically, Campbell Soups versus an index of restaurant stocks, and that has very much bottomed out and started turning. And that has been reflected by some of the companies that are probably those that are giving the negative forward guidance that we talked about. Against that, you've got you had Ryanair over here, you've got EasyJet saying that things aren't that bad. IAG were okay. You've got Coca-Cola saying that they're fine. Some of this stuff is very stock specific, etc. So it's just like Intel, they got smashed, but a lot of that was down to their own lack of AI chips and being behind the development curve, etc., etc. So there's a little at the edge reasons to worry, and it's good to see that narrative come through because it helps bring the rate cuts forward. But that isn't necessarily as end of the world, maybe is what they're saying. But then you've got the CRB index, the commodity index. We know that China stopped stockpiling copper. As I mentioned yesterday, we still think that they are importing gold, but not through the official channels. There is a big physical buyer around, and we want to know who's going to declare that. And obviously iron ore, steel making, that has been something that has been well bid up by the Chinese previously. The lack of that is what's caused a little bit of slowdown in some of the Aussie trading numbers, etc. So we've got to look out for that, because if they're right in terms of the Elliott setup, it's an ABC, which at the top, quite close to the top of the C wave down, and there's 20% more downside. For the quality index, any good thing for us from that is that will bring down CPI, PPI. But as I said, that also brings us closer to deflation. Be careful what you wish for. I said data slows down quickly, and inflation equally can slow down super quick. And prior to the Ukraine war and COVID that brought in the supply chain issues, we've thrown how many trillions of QE and not got any inflation upside. I think the danger is we've absolutely choked off any inflation. We've been slow to cut rates. By the time they're moving, they won't be able to play catch up, which all sits in nicely in that hard landing versus soft landing. At the moment, everyone's going, it's chugging along nicely still. They're just aberrations at the edge. Yes, they are, as long as you keep them that way. But head in the sand hoping they'll go away isn't necessarily going to help. Hard landing ends up being good for gold. You get bigger cuts. You get more doubt about whether the policy's right. Does it end up stoking inflation? The perception for the market will be that it will stoke up inflation, and then they'll have to put rates up again. So it creates volatility and lack of clarity. People again go into gold. The interesting thing is the Chinese stock market looks to have gone through quite a lot since the top, obviously, in 2007. The pattern of consolidation since then has been lower highs and higher lows, a triangle sideways, and that triangle in 5 waves looks like it may well have bottomed. Maybe CDE, we know that they break out. We've talked about those before. So they may well be about to enter upside, which I talked about. If they suddenly, their companies start just getting the money back in and selling their products, then they could obviously have a bit of a relative bounce back. How does this impact oil, Shiv? Good question. In the market, I'll go through gold in a minute. So I think it's either already in a sort of 1-2 nesting breakout, or just putting a further low on that June the 7th consolidation low, but we'll talk through that. So I still think there's upside left. Oil-wise, I talked about this a few weeks ago. It's been so difficult. I was so bearish and got myself talked out of it with OPEC, etc., and the bounce, which I thought was going to be a dead cat bounce. Anyway, it ended up being months of going sideways, and then we've eventually blown up. The American supply of oil and the fracking boost, etc., and they've used their special reserve quite a bit, what they think is super high levels. I said when OPEC did it, they might have made a mistake because they really need demand to hold up. Chinese demand, as we've seen, has been shocking. US is now dropping back relatively. I think there's possibly an OPEC. They don't know what to do. There's a possible OPEC cut coming again, which won't make any difference. The US will just step in and fill it. So it needs to hold the. It's not far off it. The low of the original leg down. We said we were on the watch for that. We'll go through that in a bit. If that breaks, then we're talking, 50s, 60s as potential for oil. Now, there has been a lot of chatter that the mid 60s would be defended by OPEC for a while, but surely that even they're not that stupid to just concede the market completely. We'll see. But America, it's in their interest going into the election, leaning on that to get the rate cycle through, keep the inflation from energy as muted as possible, because that does hit people in the pocket and also gives a feel-good factor when they're filling up cheaply. So it depends. And Shiv, I think if they're not doing massive rate cuts, if they end up just sticking to 25s, then it's probably not enough to get to kickstart super demand for the economies. Will be chugging along a little bit. So I think oil is stuck in a downtrend at the moment. It may have little blips up, but net it's looking more like the original idea at the start of the year. But we'll have a look at that a bit. So, are there any other things that anyone's seen that they want to talk about? Just try and find stuff I've written about. I'll just go through some of the weekly charts that I put in because I think they're interesting for what I've been talking about. So I want you to be aware of this. I've spoken about this. No one's ever come back to me, so I'm not sure if you all get it. Nominal GDP growth. Nominal GDP growth is activity, demand multiplied by prices. So prices at the nominal level, that includes inflation. The numbers that you get that the market looks at are real GDP. So that's nominal GDP minus the inflation. So once things start turning down, you get a double effect from the inflation. It not only isn't in the nominal number because the prices are lower, but then you're still taking off whatever the inflation is from that to get real GDP. So at the moment, nominal GDP growth for Fed's funds are basically bang in line around 5.5%. But if that starts falling, if the GDP nominal, and I say this is why we need to watch the Atlanta Fed because it is jumping around all over the place, but currently is still at the run rate that the official real figure said at 2.8. But the issue you get is when the GDP growth falls below the level of interest rates, then you're into negative. That is when you start to get a recessionary environment. Why? Because the nominal growth, if that starts going up less than what the inflation rate is, then real GDP becomes negative. So say nominal growth is 2% and real inflation is 3%, then you get a -1% print. And the reason I say it happens quicker than people expect is because we're not looking at both sides of the equation. So if nominal suddenly starts falling quickly or slowing down, mainly due to the prices falling, and the inflation hasn't quite reflected that, that is when you get this big double whammy and you hit recession quickly. And that's how the Fed have been caught out a lot in the past, and they end up having to do 50 and 75 basis points. So these charts are very important. Where you need to keep an eye on the GDP data as well as inflation data. That's where the link comes, rather than you just blindly looking at, oh, things are chugging along beautifully. They may not necessarily be. So sometimes it is worth going in and looking at what the actual nominal number is. Very few people tell you that because they want to know what the real thing is. But when we're on the edge of slowdowns, you need to know what's happening. So in that situation, not cutting is actually tightening, which is the reason why everyone's telling them that they need to cut. It's a time and trusted model. Nothing's changed. And it's just strange how the Fed are talking around it. They've been data watching for months. The data's getting worse and it's still not. They're not there. It's very odd. So that means if they're not doing monetary policy, you want to do fiscal policy, which is spending, but they can't do any of that because they're already going gangbusters, record national debt, and the interest rates to pay them, which we talked about earlier. Look, the US is double, so there's a massive incentive to get rates down if they can. So it's even more bizarre why they're not trying to catch up with the rest of the world and get those lower. It's hurting them, double whammy. That's why the bond market, I think, is massively caught up with where the data is. They look at the world in terms of glass half full, things slowing down. They've spotted it slowing down quicker than the equity markets. Money has started coming in, and we start to get the yield curve going the other way. People are buying long-term debt. You buy long-term debt when rates are falling. You get a geared effect, duration, they call it. It's leverage. It's like being beta weighted into stocks. So last week, Treasury refunding was a biggie, but it's not the biggest quarter normally. And it turned out not to be. It came in line, 125 billion. And they said explicitly 15 to 20% in short-term debt is not a problem, and he's not painting the tape, not trying to get away with things. L'Oreal Rubini had been having a go at them about that, saying that it's not a true situation, they were cheating, etc. But they booed him off. So Bletchley, that's an answer to what you were asking last week. Will the value of USA debt, will the Fed keep rates higher than the rest to make sure people are still buying it? Yes and no. They're already having to pay too much to borrow the money. They need to get that down. They'll try and relatively have a purchasing advantage, but without killing themselves. And that's another thing that was mentioned by the Bears last night. The fact that China and Japan particularly have been selling US treasuries, they've been historically big buyers. That has a twofold effect. Obviously, one on the US bond market itself means they have to buy more of it or find alternative buyers. Now, if you've got a rate cycle like we think we have, they won't have a problem finding buyers. It's what happens when that stops. But what it also means is with JGB interest rates going up, then having been zero for a long time, intra-Asia and for China, etc., it becomes somewhere that they may want to start investing going forward, and definitely gives them a reason to sell the US treasuries and start buying China at the margin. I think what that affects is a thing called FDI, foreign direct investment into states. That has been on a massive downtrend since the China started changing its reserve mix and wanted to get out of dollars, and also since the Ukraine war, etc., etc. If that continues, that's another reason that people are saying overall, big picture, the dollar is in a weak scenario. That's why the dollar should go through 100, etc., etc. So keep that all in the mix. FDI, you need to keep an eye on how that is happening. It all affects the global macro picture. Hydex Foundation, hi. Welcome to the party. Funny enough, I was talking about this. What would help would be direct fiscal policy into infrastructure projects. The UK are talking about it, have been for a while. The US have been doing it. China try to do it. And every survey taken amongst investors and the public at large say that they would support direct investment. So why it's taking so long to get done? But there's a lot of chatter from all the US parties in the last week about deliberately trying to go down that path. So that takes pressure off issuing at large, because you've got a captive audience that will support it because they know the money is going to direct projects. And then you get construction benefits and manufacturing benefits, etc. So yeah, another one. Keep a look at those headlines, because that will be rates positive and risk on positive. So I'll have a look at that in a minute. But last week it was total 100% for a rate cut, because we're currently 525, 550. September this was before Friday's disaster. It was already over 2/3 suggesting 50 basis points. So while we're here, I might just try and find that. Yeah, so no change, still fully expected for September. It's just moved to 66.5 versus 33.5. So slight, only at the margin, people thinking only 25 bips. But just be careful the way they're talking. I said that could again be a little shock for the market, might extend the dollar strength, because at the moment I think most people will tell you 50 bips is coming in September. But it's how we go through the next couple of weeks of data. We've got 2 CPI, PPI, PCEs, one more non-farm payrolls, one more ISM, etc. So there's a lot of data to get through. Now, big things at the edge of data that hasn't really been mentioned. Employment cost index, that dropped unexpectedly. That is the Fed looks at that rather than average earnings on the non-farm payrolls. So that gave them a big tick. Productivity is the one that sometimes gives the Fed officials wriggle room, because that suddenly jumped back to 2.3%, back to where it was Q1. Q2 had dropped unexpectedly. So we'll have to find out the reason why that happened. But generally, when it's predictive, they don't necessarily have to worry about getting the rates down as quickly as if it was falling. But with people pulling back hours offered for work, etc., and people still working hard to keep their jobs because they don't want to lose them, then the productivity probably has a potential for being a false read. So we need to see that mirrored again once we see the Q3 figures. But if anything, that might be a reflection of the AI benefits starting to come through. What I talked about, people are literally producing 40 to 50% efficiency gains for companies that are using AI processing, enterprise resource processing, ERP stocks, SAP massively beat, ServiceNow beat, Palantir beat. So all the people under the hood are doing the right things. That again, that might be driving this productivity boom that we're expecting. I talked about it on Thursday, the ISM manufacturing, but remember it's a smaller part of the economy, but it did read through in the right areas. ISM services then came in on Monday and sort of basically came in line. Everything, the index jumped back to expansion. The employment side of that was still okay. So they're going to lean more towards that being an in line. Again, that really does lean more towards 25 basis points for them at the moment. But it's all in the mix for how the next data comes out. That chart there is what we talked about. When it starts to steepen, that is when the short-term yields are below the long-term. But historically, that happens just ahead of recessions. Forward return. Just like the SARM rule, it's another version of the SARM rule, basically. That hasn't got a 100% record, but there's a lot more instances of it. But certainly in the modern era, since the 70s, it's been a big predictor, which is why everyone was originally warning about it. But if anything, the Fed are quite right that things are under the hood, still bobbing along nicely. It's just, as I said, the headline numbers can suddenly implode because the nominal part of activity disappears up the jacksie. Bank of England was interesting, and Hugh Pills stayed on the bear side, ended up as a 5-4. That means it must have been 4-all. We knew Bailey was a casting vote. We've talked about that for months. So if we just needed to get to 4-all to get it over the line, that's happened. Now Bailey has gone out of his way to say, even though he wouldn't define exactly what would drive it, his overall path to rate cuts is still in place. It's just a case of convincing the others that that is the case. So we'll have to look out for the language. Pill is really playing devil's advocate because as soon as the data shifts, he will shift. He sort of hints at that. He just wants to be super careful. You have got the external members, Haskell and Mann, that are the real problems. They're a bit intransigent. Mann particularly has her own ideas about things. So I talked about before, she voted for a rate cut just because she was angry that a rate hike, just because she thought that the market had moved rates too quickly to the downside. It's like, well, just warn them that they might have gone too far. You don't need to put an unnecessary rate hike in. So she lost all credibility with me when that happened. So we've had a mixed tech sector. We talked about that last week. The bizarre thing was, I said most things should be all right, and Meta will probably mess it up. But their investor relations totally all over it, and they're the ones that gave the right message. CapEx is definitely continuing, remaining in short term. We are monetizing it. We're getting ads, blah blah blah. There's a pro forma poster child for how the others should have really approached Q2 earnings. Apple, we saw the whole thing with Berkshire Hathaway. That was all done before results, before the weekend. That was Q2 trading. So they've been trimming that into rising prices in the main, a little bit of volatility. They've still got 65% of their holding. So it wasn't exactly, they weren't exactly praying for Apple to have a miss. But, that's really more of a case of that's been their big super outsizing. Like half the funds they had are in Apple, absolutely bonkers. Now they've got a better setup, 84 billion and then 277 billion in cash ready to react. Bloke's a genius, or is he? he moved a lot of it into the topics in Japan, which has had an intraday 3-day 25% drop. But net, he moved into the right areas. Insurance is where he moved into, and financials, that should be okay or rebound. That's what drove their earnings. The stock was off a little bit, but they're basically, as usual, doing all the right things. Elliott calling tech a bubble. Do they really believe that, or are they just trying to get things down so that they can take it out? Be very careful of what the investment setups are of talking heads and talking horses in the market. Do you want a clue that AI is definitely here to stay? We talked about underlying companies. What about the banks who do the raising of money for them? Blah, blah, blah. They have been doing amazing investments into their own AI. JP Morgan have spent $17 billion so far, plugging 50,000 workers into their own AI processing tools. Morgan Stanley did it at the end of last year. We talked about Cycle, that company that I've been looking at. That's a UK exposure. Have a look. There's still only market cap 25 million. That thing could go absolutely crazy. That could be the poster child for AI exposure in the UK. But I'm not telling you to invest, but have a look at it and see what you think of it. So really a nice little blow off probably for the AI side of things. Tech-wise, EV production, the whole EV false narrative has always been a problem for people of balking at the prices. China, again, it's another one of the areas that they've oversupplied, caused issues. There has been a decent switch in the States, but Tesla being the poster boy, disappointed. A stock overnight, what was that called? Vividian. Rivian Automotive, again, they maintained their guidance. They got hit really around the edges, just not making money out of it. So there is an underlying demand for the EVs, as you'd expect, but the headlines always come out on the negative side of things there. But there is, this whole pricing issue, and China flooding the world with cheap versions. And they've got totally owned the battery market. The battery market has been this two-way pull between their idea and the lithium thing versus the whole cobalt. Interestingly, Glencore were out today saying they're no longer stockpiling or mining any more cobalt for the minute because prices are at ultimate lows, massive oversupply. So it just tells you this is another area where expect going forward to get some deflation into the system. So inflation to me is, even if you've got any short-term blips, that's literally all they are. There's nothing endemic, anything that lasts here, unless there's some mega policy mistake or things start getting super hot in terms of growth rates. But that's very much down the line. As I said, we're going to have 2 years post the US election of a lot of to and froing and a lot of cheap products around. So take advantage of it as a consumer. So we had that rotation. I think the rotation went from being interest stocks out of tech into value plays. We thought that had gone early because they were well ahead of the rates by about a month, the normal rate cycle. And now into people that look at all those seasonalities. Fabo puts some good stuff up from Goldman Sachs. I've seen similar stuff from Bank of America. And the Russell Index, the first 2 weeks of August is always a nightmare for the value play Russell. The second worst week of the year, apart from the second half of September, is generally down 2 to 3%. So that rotation was always going to be a tricky one to keep going, and it's been a rotation into bonds, out of tech. And if anything, as we started the whole piece, this was a rotation out of leveraged plays. So reading through all the info, all the positives and negatives, it still comes down at the end of the day to the carry trade unwinding. Most of that's been done. People might even start hedging back into it. Looking at how UJ's gone, they have started doing that already. The fundamentals of unwinding was driven by the US side, not Japanese. Ignore the headlines. Japan did what they had to do. This was all done by the rate cycle being fast forwarded by the market at large in a panic. And that caused a lot of people just to have to get out of that trade because if you went on earlier, break-even rate for neutralizing or this normalcy we talked about yesterday for US rates is back to sort of 3%, 250 basis points off the dollar, and we're going to get UJ back to pre-COVID levels, and that was 100. Somewhere in between 128 is possibly realistic end point for continued unwind going forward, subject to how the US plays out. But have it in the back of your mind just how serious the whole unwind could go. And then I was looking at AAI, the American Association of Individual Investors. Historically, that's been a really good indicator when you look at what the bull-bear spread is. That is the number of bulls plus minus the bears. When they get to super high extremes or super low extremes, they're good for 10 points. But they had a decent, they always put a special question in. And it was one of those like classic conundrums when you face the door with the guy that lies and the one that doesn't. Do you think other investors are too bullish or bearish right now? And they're asking that question into pre-Thursday, so pre-ISM manufacturing and non-farm payrolls. Had 46% saying too bullish, and 30% saying that the market is about right in terms of sentiment. Only 13% saying bearish and no opinion. 10% they don't have 10%. They don't have a clue. I imagine it was something like 90% didn't have a clue by the time we got to Monday. But that was a strange market reaction, really, because we've had a 10% pullback for Nasdaq. After 77% think that the market should be lower, effectively. So it was. It was a good way of them reinforcing what wasn't coming out in their bull-bear spread. That was kind of a bit more neutral. So they took it to the second derivative, which is a effective change of change. And they asked people, really, this was basically forming what would be an extreme level for the markets. And they basically identified it with 77%, thinking that it was totally overdone at a high. That wasn't like being at the lows. So it was kind of suggesting that people were very ready to panic, which is what we got. And then, obviously, I did the usual run through the charts. I talked about that wave 4 could extend into this wave 4 zone down to equal legs. We'll look at see whether that played out. Same thing in UJ. You were talking about getting into this one spot 168 range. Aussie yen, the whole year-to-date gains wiped out in 2 weeks. Absolute crazy stuff. And then this got even worse. The Nikkei I was trying to show into Monday's preview had already gone from 28 to only being up 2%. It actually went down to about 6% down on the year. The intraday move was down 12%, which brought in the whole hasn't moved like that since 1987, etc., etc. And topics was just as bad. Again, we were looking for double correction. Once we'd broken that low on the Nikkei we talked about, we thought when it did it here, it said that looked like being capitulation time, and it's going to go to double as we talked about that last Friday. And so it proved. Didn't expect it to go as much as it did. Topics again, look, 20% off. This is where Buffett, etc., had gone in, got all these gains, super. I mean, has he been buried in that? I don't imagine he's been selling. I think we might find that he's been adding to some what he describes as wonderful companies at fair prices. That's how he does his shopping, and I think we're probably baked in some lovely enterprises for him in the whole Japanese model. It's just a little bit crazy, overdone. It's a slight change to the exchange rate. The topics itself is mainly domestic, and a lot of those financials gain from the yield curve, actually having a little bit of steepness in it. You talking of yield curves, this is the downtrend since May in US 10 yields, as it was trying to take out that inversion. You can see that the yields have been in a downtrend path. There's some people on Bloomberg just talking about 4.25 for this consolidation channel. If they saw that break, they thought it would crash through the bottom of the whole channel, and that So it proved that was quite a good call by that bond investor. That again, this was people catching up with the data. This all broke down on ISM and non-farm payroll because everyone thinks rates are going to that mid threes again. But ironically, in the bigger picture, which we can have a look at another day, is this is all part of the correction. This downtrend here is a C leg to an ABC. Things might not be as comfortable this is the bear argument. Things might not be as comfortable in a few months' time for the US rate picture. But in the short term, we've got much more potential for the going down there and getting the dollar down as well. This was the dollar. We expected it to crash down. We've been talking about that 1-2s, and this here had been a nest that was a 1-2. And I think we can definitely say that was an impulsive third wave down. We've either put that in or not. We'll have a look at that in real time in a minute. But I've been expecting a bounce. It's a case of whether the bounce we've got at the moment has one more leg down or whether it's going to be a proper high degree retracement. But either way, we're very close to it. I'm expecting that turning point. We've had a couple of days of dollar strength. Pin the market, which rate do you expect to be maintained? So that was the preview in the main. Where most stuff went on. I still think that is picture of the year. Thank you, Paris. We're going to live on that for a long time. So that's interesting. The oil has continued to have drawdowns for the last few weeks, yet demand has been imploding. So what's been going on there? So potentially, what just about this morning, trade data from China, their imports in oil have gone up 8%. So a lot of this global drawdown may well be stockpiling by the Chinese rather than natural signs that things are picking up, which again is why oil hasn't particularly rallied that much. A big issue and I'll look at where we're up to at the moment. I keep talking about it. Obviously, you will get it overnight after the event, but it starts explaining what mode gold is in, and the first 5 days deliveries for August, that run rate, as we talked about on Friday, of basically half of the biggest month so far for the year. So August is set to be the biggest month per year for the year. It's at 17,000 contracts. It was 9,000 here when we were talking about it. So the UK did really well, really, because the manufacturing PMI and the services yesterday have all come in above expectations. So that would have got in the way of a rate cut. So they're taking advantage of that period where they had to cut. And so there wasn't really a lot. Yeah, so Bailey's basically said he sees a clear direction of being more rate cuts, others don't. He wants to see the true path come out of the data. Some things are stable and declining, others, some of the services are not. And they're still worried about there being a world tension event. But if anything, remember, if there's world tension, etc., anything that's going to cause any more interruption to world trade, everybody will cut rates. Make no mistake, they'll do a coordinated cut. So again, that might actually act as some insurance as well. But yeah, that was totally bizarre. Fed Schoolsby, Bloomberg, guess you might not have seen it. You may have seen commentary, but it's late Friday. still talking about one data point, and yet he's the one that's pointedly been saying that there's been a number of data points and that there's enough to go. I think Powell just obviously told him not to say anything at all. He has been Powell's main man. Normally, when they do that, it's because they are about to do something. So we know everyone expects it, and I think they will deliver. The danger now is that it's 25. I think 25 basis points because the carry trade is almost. Is that negative or is it a risk on return? Certainly would encourage people to average back into the carry trade because it'd be a much slower path for rate reduction. UJ goes up again. So anything into this week that we've been talking about? I've seen the rest of this will do for next week. Just while I've got that page up, you can see we can expect the rate cut in September, despite the fact some senators are really pressuring for it sooner. The Fed stands right. No one, unless something craters again. I agree. I don't think they're going to do anything at all other than push it back. They wanted to. The idea from the market prior to last Thursday, Friday was that Jackson Hole was going to be the one that cemented that. They're a little bit dyed in the wool at the Fed at the moment. They've got a two-way pull in the room. I think they're going to do it at their official and semi-official things. We might see much better commentary at Jackson Hole, which is where we started. This was the VIX index up to 60. We've been talking about this channel, but a much higher gradient on the normal chart. Moved it out just so you can see. So this is the GFC, COVID, and then this intraday 65 on Monday. We've since returned back into the mid-20s, which should be enough to be considered sort of back in the normal range. And if we want to see risk on, they'll see it come back into the channel. In general, services were still in expansionary mode, although they missed some of the expectations. A little bit of froth coming off the top, even in services, so they're not going to be complacent. Germany, ironically, actually beat. Their composite beat, despite the fact that their manufacturing was still poor. Eurozone not really going anywhere, still flatlining. So UK manufacturing was relatively better, as was services and the composite. This was the odd one that the US services missed on the global reading, the one that comes out Q3, and that made the composite miss, whereas ISM actually beat on the services side, which made that composite, how big a beat was it? Yeah, that would have made it slightly up. So in general this year, it's been the other way around. The ISM has been underperforming the S&P global manufacturing. Maybe that's something to be wary of. It looks like that one has been leading the S&P global. Right, so that's enough of all previews. So S&P equal weight. How's that been turning out? So originally the rotation started, we got that breakout, we said we expected that to return to normal. Obviously, we said the seasonality may take it through the bottom of the triangle. Boom, it's been in and out of it for the last 2 days. It's tried to regain neutral today. But net that is suggesting the rally is taking place overall back into the bigger tech relative to the lower weight rotation trade. Something we don't trade, but again, this came up on the bearish call last night. They were adamant that this was either the end of the super cycle for Bitcoin, the 72,000, what was it? It's nearly 74,000, or we're just doing a consolidation here before it puts one more high in. But they think, along with weak dollar, that Bitcoin's still going to get smashed somewhere back down to into this territory here, which was a wave 4 territory on the way up. So sort of sub 40,000 at least. But I'm only saying that. Just keep that in the back of your mind. I know that Raoul Pol, who's the big super bear, super bull, talks about the banana liquidity, etc., and that is going to come with the rate cycle unwind potentially. But again, anything underwhelming from that rate cycle, which I'm beginning to lean towards, if we don't get the data following through, you'll see further downside in Bitcoin as well. Which one leads it? I don't know, but just look out. If Bitcoin starts coming off, then we're going to have a little bit of a risk-off scenario again if that starts leading it. So the gold boy. Actually, before we do that, let's just look at. So this was overnight CME data. It was a bit later last night. It came out at 2:14 in UK time, didn't it? That's 5 hours on from that. That's 26, 2:14. And that showed you that there was only, as I talked about the day before, there had only been 14 deliveries and then 5 deliveries for that basically be tomorrow. So the underlying demand trend had slowed down. Remember what I was talking about earlier, for anyone that hasn't been with us, 16,455 for the first 3 days of August delivery, because that is intent the first delivery on the 3rd. So that was why we're having the real demand. Obviously, they got away with it on Monday because gold got caught up in the whole unwind of outperformance, somewhere that borrowed money had been invested in, etc., etc. So highly likely that you're getting margin calls and/or a few panicky physical hands just settling into that physical demand. But if things settle down and those contracts come back and mirrored, then that is what will drive us to the all-time high again. Now, I put that piece out yesterday about China potentially doing their importing of gold at the moment via retail channels that suddenly disappear. They don't end up in the numbers anywhere in China. They're not putting them into their asset reserve at the moment. Now, obviously, to put it in there, they have to have physical gold to match it. So if they are nicking gold from other sources into country at any point, they can suddenly up their official asset reserve ratio in gold by showing the 85% of physical for whatever they want to do. Maybe they are waiting to do that for a breakout moment, potentially around the BRICS unit thing. But certainly, oddities in the global market, 400,000 ounce bars are being taken into China. We're not quite sure who it is that's picking them up. So how does that fit with the pattern that we were on a minute ago? And obviously we've been talking about this 1, 2, 3, 4, 5 pattern. We're in the 5th wave of the fifth wave, the third wave, which we're expecting to get out of here, potentially 2600s now to finish. We are putting in deeper 1-2s all the time. We put in 5 waves for a 1. So last week's failure at 24.75. We've done an original, what looks like a very plain 3 swing move down, in what should be the minute wave 2. Sorry, sub-minute wave 2, and then we're expecting the third wave to go to a new all-time high. It needs to hold the current low. Which is 23.64. Otherwise, it becomes a different pattern. Then it would be extending wave 2, and then that would need to hold that 23.52 low that we had over here in July. Ultimately, it's the June low that needs to hold, which was the wave 4 at minute level. That was the 22.86 low, wasn't it? So that's the ultimate one for change of structure. Within that, we're still creating what is a bullish phase. Now, I'm pretty, at the moment, quite happy that we're still within the 4th stroke 5th wave. This 4th wave may be doing an extension. It's only super complicated that if this gets taken out, we're then close again to having to extend the 4th wave, because it's all very much sideways pattern with upside impulse. That isn't normally what happens if we had topped out and were in a negative. Most of the downside impulses are three swings and consolidating waves, and then 5 waves down. So it has the pattern of being in an upcycle. The fundamentals are in an upcycle. It's just a case of how that plays out now. We talked about manipulation when there isn't physical around, so it's a bit easier to lean on it because there's no one calling for delivery. And the Fed does, like, as we keep saying, sell gold by dollars to support the dollar. In the situation that we've just had in the last few days, highly likely that a lot of this sell-off has been to do with Fed supporting. Things calm down, we may start to get a reverse of that. Physical buyers come in, less need to protect the UJ situation, and that might be the catalyst to the breakout. But at the moment, if you're playing longs, it's very much previous trend within trend lows. But at the moment, that gives you sort of 23.80 level. And then with a secondary support down here, 23.65. So yeah, I need to see the 7th of June low disappear to potentially make me think this is an extending wave, and we'd have to go deeply into 2200 sort of territory to actually be in this ultimate all-time high of having taken place over here. But I don't think there's been enough subwave at the moment to suggest that is a proper topping out process. So I'm sticking with the bullish pattern for the moment. The bollies, I haven't set out yet. Especially if you're looking at the Fibonacci Bollinger Bands, but that's something I'm going to look at. This is the classic Bolly Bands. Last week, because of the volatility, I put in the 3 SD, that's the grey line on the outside. That's not normally the trading. It's where the dark blue and dark red are. And it's the 1 standard deviation to 2 standard deviation bands where you need to be careful. So you get the trending. We saw that on Monday. Look, it never got out of that channel. So normally when the mean reversion, once you've gone through that red channel, we expect a mean reversion, and it got back to the middle before dying again. Didn't get the crossing of the absolute channel. It got walked down occasionally you got taken, you needed 75% of the bar to be in the neutral zone. So you stopped out in that one, in no man's land trading. Didn't really go back in until this bar here. At no point did that get you out again until that one. But you had a lot of flip flopping, 15 minutes here of going out and back in. But ultimately, once you went back in around 11:15, you would not have come back out again until you thought this band here at the super wide volatility was having a real effect. You may have cashed in, you may have held on until this second candle here, which would be your proper rules abiding exit. But you would have already captured, a huge move, 25. You've had 40 points out of that just purely doing it on the 75% rule. So it can be quite powerful. It certainly helps you avoid taking on the falling knife. So once that re-enters the standard deviation zone, at some point it's going to go through the 2 standard deviation at the top. That took quite a few periods. And like I said, it's not really necessarily a buy zone, other than the fact that you're at super extreme volatility. That often is worth having a stop loss buy. By that, you know where the band is, so you can have the stop loss 75% into that. That didn't really go anywhere. It did cross, but then it took ages, didn't it, to even cross again. We went into super tight volatility. Now, this means, by definition, you're in low vol, so it's going to explode again at some point. So we got this cross. So we got into a lot of volatility, lots of sub crosses. And at that point, it's been pretty much, to me, until yesterday afternoon, around the time when we were talking about, said it's in no man's land, we might get some downside. I still think the trend is in place, but there's going to be trading sells. It suddenly went into a risk off period across all assets going into the US Open. A lot of them noisy trade. For the majority of the rest of the day, it was in noisy trade land until it went bullish. Got walked up for a few periods overnight. Again, you wouldn't really have been trading that. At the moment, we are in a 3-candle long situation. If you bought into that on the back of this candle, you haven't had a signal to stop yet. So at the moment, it is in a bullish short-term trend. Any questions at all for anyone out there? Well, there you go. Look, headline: dollar to rise if Fed dampens rate cut bets. We've just been talking about it. Maybe they're watching. Any giveaway? I haven't got any giveaways afforded to me at the moment, so sorry, you'll have to use a discount. Is it always 20 at the minute? There is a giveaway attached to. I think Alex mentioned about, is it like some of Riz's videos or something? There is a giveaway channel, isn't there? Go and have a look at that. I haven't got anything live on the show at the moment. So the dollar big picture that we've been talking about, series of 1-2s. We had an expanded flat as part of that into the June wave 2. Since then, we've been playing out the latter stages. It's potential wave 3 is what it labelled. It's sold off what we saw as a 3-wave swing, wave 4. And it's all about where we end up. 2.5%. It's already done enough to qualify as being a valid 5 waves, because that 3rd wave down is 2.41 relative to 2.29. So it doesn't really matter what happens to the 5th wave. You can get rid of that. It's already almost equal legs with. Actually, let's do that. Yeah, it's a tiny bit more So it's highly likely that it doesn't matter about that pattern. I think there's one more low in that. The way I've got that labeled, you've got a one down consolidation, a really impulsive move down into the panic. Since consolidating, it's all about where this consolidation ends. Then one more low down into this sort of area down here, 102 kind of break, and then look, 61.8 classic pullback for a high degree wave 2 would be 61.8. That takes you all the way back up to 106.5. Doesn't have to happen. The 38 fib here, if this is a week bound, so we've got data reasons in between, then it's already don't know if it's in a 38 fib, these black lines for what I think would be a fourth wave, which is why potential for it to put in another fifth wave if it continues down. There may be a way of labeling this as already done as the fifth wave, in which case we're into here. Targets are 103.70 or the 106 level, I think. We'll just have to see what happens. But what it generally means is we're close to a little bit of consolidation before the ultimate sell-off comes in the dollar. This isn't placed for time. That really should be over here. So some form of short-term recovery. This could all be down to the data and the commentary at Jackson Hole before. So a little bit of safety, a little bit of retracement. Jackson Hole might be a release or some one of the data points, and then we're into the daddy sell-off. But this time it'll be potentially positive for the market. Depends. What we have to be careful of, which is what I said at the start, why we might end up in consolidation for the indices, is the literal timing of all this. This is taking us into September, and that risk-off data inspired sell-off of the dollar may well be just taking us into that normal September seasonality. So that might be the turning point for the equity rally, and we put in a double correction, another low, but that should finish the whole thing off, and then we're into the election cycle, which is normally a positive. We looked at the government bonds. So read through from that. Obviously, UJ's had a lot to do with DXY at the moment, but it isn't the biggest weight. The biggest weight is the euro. I haven't moved anything since Friday, and it's almost played out. We had the spike. We said we'd get the 110 spike that we were looking for. We got that new high into Friday's blowout, and then we're looking for a three-wave pullback. Now that has potentially a three-wave pullback. It's going to put in a new low, or it could be doing a double. In the previous degrees, wave 4, we are within that already. So it could be anywhere within that. Actually, 107.76 is the sort of stop loss there. Again, it's one of those annoying mid-range, but the pattern's been playing out. It suggests that we've got one more high to come, which is one more period of dollar weakness. And then that changes. So this, to me, feels like we could have a double extension relative to that. What we're saying, the dollar could have another high. It's all about where that plays out in the near term. We just have to play it on the fundamentals. We're halfway. It's a coin toss which way that goes at the moment in terms of setup, but there is ultimately one more high before it consolidates properly. So stop loss accordingly, but then net, there is a little bit more positivity left in EU. GU should be similar. Again, GU, the only issue I've got there is whether we've put a connector in on the bounce on the because what did we get there? We got the Bank of England sell off. You put a connector in. So we could easily be doing another, I think it'll actually be from this, a double of that, and we're almost at the double. That was the original connector. So maybe potential for that to come down here to 126.388, but it could have been enough already because it's through 61.8. Again, you've got a stop loss here, 126.720. It looks like we're still, the argument is we're still very close to turn, and it's all about what happens with that dollar turn. Now the time to sell gold. It depends, like I say, if you look at it in terms of percentages, then I don't think it's got masses of downside left in it. The fundamental physical buy isn't in the way, so it's quite easy to try and use the paper market to get that down a little bit. But there's potential for 5 to 10% rally very quickly if you're not careful. So just don't do it blind. Make sure you know that you definitely have a technical reason why you're doing any shorting. So the daddy boy that's caused all the issues. Okay. So we talked about this, and I still haven't changed it just because of the nature of. I've changed my mind. So put in cycle 3 top into those 5 waves, really distinct channel. A number of opportunities for 3-wave pullbacks, which we looked at the first one there. We had ended up with consolidation. We came down again for another 3 waves. This was a potential. It's all pre-meeting, all pre-end of the month, and we said the danger would keep being small consolidations and then putting in doubles. So once you got to there, the double for that took us more or less down to here, and we're talking about the potential was for 152, 150 to break. Now the move down to 152 at the moment pretty much looks like being the first leg down, the W leg, 3-wave, bounce the X into the end of month. And the meeting, we got the Bank of Japan doing what we wanted. That's put in the first 3-wave move down, even it's a 5-wave. It's actually a zigzag, so we knew we were going to get an extension. Then we were looking for another impulsive 5 waves down to complete. So at the moment, we've done a WXY load of double corrections, super complicated, but quite impulsive in its downside, which tells you it's of a higher degree. So we're pretty sure that the length of it is a wave 4. This still keeps us within the double correction zone, the 1 to 1.168. We've had a bounce, but look at it so far. Just at the bigger picture level, that looks very much like an ABC, even a WXY within that, a connector, whatever. So this needs to develop into stronger 5 waves, which it may do, like trying to approach 150. Then we will have a sell-off, and we need to see exactly what that looks like as to whether this is all part of the bigger scale connector, in which case this whole move from 162 to 142, 141 from 150 could replicate. So that's another 20 off there. That gets you down to 128. Good enough. We mentioned that earlier as being a potential stopping point on the way eventually to 100. Worst case scenario, but that's possibly going to take months and months. But just have that in the back of your mind. It's very important how this bounce develops. If we are having a UJ proper rally back into 50s, that is because the rate cuts are going to be back on the 325s for the year basis. So that is an instrument to play instantly once you start hearing anything about we're only doing 25 and we're still struggling to see the data, blah, blah, blah. This thing is going to come straight back up to 150, 253. and still not necessarily be finished for its downside. It could just, that is the ultimate consolidation bounce back wave potential. But hopefully that makes sense, and you can see how we pieced it together. We had stop losses all the way down just in case they broke the previous three swing low. So you did have a chance of even of being bullish and not getting beaten up too much on that on the way down. If you happen to go bearish, you've absolutely had it off. And I think fair play to Bodge. They did everything that they should have done. And they've played the blinder again overnight. Over to you, US. You can be responsible for the next move. We'll see how that plays out. Nikkei 225. We've been following that since the start of the year and have done really well out of it. We'll expand it in a minute, but this is the bigger picture. The super cycle top in 2018, COVID low, super cycle low. Since then, we've been into a grand super cycle, the way we're labeled cycle one, move up to going back to current all-time high levels. And it very much looks like we might have to say that fifth wave is in. We'll look at that. So post that low, we had the 5-wave move up one and a 3 swing down for 2 low. We've been playing out the 3, 4, 5 of potentially this, like I said, this blue super cycle 1 bull market. That's 1 of 5 eventually up. So it's all a case of where we are. So what does it look like? That's on the weekly basis. Let's go back to the daily. So again, a bit messy with all the sub waves under there, but just for a bigger picture, we had this 3, 4, and 5. We're hoping for a small degree wave 4 to hold the previous wave 4, which is kind of mid 30,000s. It's gone bigger than that, and because of the scale, 28% movement, best part of 3 weeks, that isn't small cycle move. So into the hourly, we'll change it. I think super cycle high is where the all-time high was previously. To try and keep it on the scale now. So in effect, 3 goes to over here, 4 over there, which means this was 5. So 1. So then we're looking for what is the relationship of, I thought I'd written that on. Oh, there you go. Yeah. What's the relationship? If that is a wave 1, wave 2 is normally retrace 61.8%, which is what this bottom red line is here. So the other red lines are the relationship between the 3 swings. Retracement is very much a 3 swing down. Being done in a 5-wave down, which very much looks like it is a zigzag 5, a 3 wave up, and then 5 waves, and then this big super sell-off. And we're now retracing. So this very much looks like Monday's intraday blowout. Is a wave 2. Look, 28% from top to bottom. So that is a serious, that is why we're calling it a super cycle. There it is, there's the label. Super cycle wave 2 down. Now again, because that's come from a long way down from the sort of 14,000 level, there is scope for it to be, from 20,000, there's scope for it to be an even higher degree pullback. And there is still, from here, from this jump here, there's still 15,000 to play with. this could do a double extension. Again, which is why we need to see this develop into a three-wave, a five-wave structure really to start it off, in which case we then have the ability to go back to all-time highs. But this definitely, the structure of that, look, it's just about hit the maximum for equal legs. Just intraday touched the one spot, 618, bounced off it, and it is, so it bounced off 61.8 pullback, just broke that. It looks very strong, as if that is the end of the Nikkei sell-off for the moment. Again, we need to keep our eye on the carry trade, but I would be expecting for this, this to get 50% retracement really before it was to turn back down. So short term, there may well be some gyrations as it consolidates, but there's a little bit more upside at least in the Nikkei. So that takes you from, so yeah, anywhere up to that sort of 37,000 level, which gives you another 5% before we can even have to consider, I think, looking out for a big sell-off. Whatever that is a line in the sand for the intraday. Nobody told me you weren't actually on there. So super cycle wave one top. I just moved the 3, 4, 5 across to take us to one high degree, purely because the pullback ended up being something what should have stopped here and kept as being the 4 before we moved to this ultimate 5 high. It's got up so big. It's 61.8% of those 5 waves move up. So that is a massive pullback. It must be a higher cycle. What I'm saying is, I'm not going to worry unless the data changes, the fundamentals change. The rally to me can go halfway before it rolls off 37,000 to get 5 waves in there, and then we'll see how its pullback reacts. It might just be connected to a move all-time highs eventually. We said on Friday, and I haven't done it because of all the turmoil. We said, I think there is a danger that what we had over here as a 4 low that had held was about to get broken. And because of the nature of sideways movement with no impulse breakout, it's highly likely we were going to put in a new low. Funnily enough, I haven't relabeled the injury waves. That pretty much looks like we put in an ultimate new low, and it looks reasonable that it's valid for that being low, or maybe just one more. It's 5 waves to finish. Just look at those subwaves. That could be a 1 with a 2 consolidation. It's all about whether this was a 5th wave at the end here and we're putting in a 4th wave, or whether that was enough to finish it off. Again, that is a 3 wave. Have this as a 17,200 is your buy sort of stop loss. Another challenge with a 50-day moving average before it goes again. But we're very close to buy territory in the DAX. It did the finishing off, or almost finishing off, that we thought. The inducements don't always play out like that. When I'm looking at it in terms of pattern, I'm looking for this whole structure over here to be a set of valid 3 waves. There's been a lot of extensions to that, and then the final setup is I'm looking for the 5 waves. So at the moment, we are still in a situation of higher highs and high lows. So you're back in an uptrend. It's how it reacts when it comes back to challenge. Nasdaq, again, showed it from the other chart. This is zoomed in a little bit. but it's very much the same idea. We folded and said that was the all-time high for the third wave. Still think there's one more high to come for the whole move. So it was a case of this higher degree fourth wave taking place. The ultimate zone for that was to break the old trend line, channel trend up previous degrees, and then hit the previous fourth wave, which is in this horizontal channel here. Within the sell-off, we said we thought that was a connector for an equal leg sell-off, and we've basically hit that. We just ticked through it on Monday, and then we've had the bounce. Again, that looks like we've had a 1, 2, 3, and then we've after 4, we've been left with what is a triangle. So for me, it's a leading diagonal up, which has a bit of complication. You've got a 1, a 2 that held on the way back, you've got a 3, you've got consolidation, and then you've got an A, B, C, D, and wherever this E meets the line at the top is where it's likely to find some resistance, 18,450-ish. Then we're looking for a pullback somewhere, spot 38 to spot 618. There's a potential retest with multiple lows over here. Looks like a strong support zone. And then we should be off into another small rally channel. So keep an eye on that. It's done a lot of hard work, and it's done a lot of retracement and consolidation in the last 2 days amongst that. So for the minute, I'm happy that we're still playing out in that underlying AI story is strong. We've shown from the SPX equal weight how that is playing out in favour of tech again. Some very supportive results for the heavyweights in the last couple of days that just support the AI argument. And it is deeply oversold. Now we've managed to get in. We're talking about the lower low on the MACD. We've had a double low into that final double consolidation. We topped out there. We're close to a fifth wave and not really breaking to new highs on momentum. That is a proper flip-flop MACD as well into an ending diagonal. It doesn't really have any leadership, so I'd expect that to then return into negative. This time have a higher low, and we'll be off to the races. Pin the market, go for it, my boy. Don't mess it up. Get that market up. Nice to hear some bulls around for once. Pin the market is looking at S&P 500. He's also eyeing Nasdaq for long, targeting 19,100. Excellent work. And obviously, we'll see how it then reacts when we get into those kind of retracement levels. So that is going to be 20,800 to 3,600 points, 17.2 to 19.1. That's a 50% retracement. So that is, again, we said it's going to be connected to the downside. That's a good ballpark in the market for a pivot point. So yeah, rule that out. Good work. Come again. I'll show you the messy chart again, as always. I like the messy chart just because it's got lots of things to look at. 50-day stocks trading above 50-day moving average obviously came back down into the sort of levels that we always get at the consolidation points. Every time we have a down, then we get this drop into negative under over, which is basically 50 less, whatever that is, so into the 40s. April had the extreme one there in the 20s. We had this 40s, again 45 here before we got a turn. And look, look how many times that's happened. Negative on the 200-day moving average, not 200, the stocks above the 200-day moving average. April, the last time, April 19th, when the market turned, the last time that went negative. And look, Monday, super negative. So I've forgotten what the actual band means on that, but the top of it has been 20. Overbought signs is normally when you're above this red line, which is like 14.4 and above. And then by definition, turning points you don't really normally get. It's difficult to get stocks overall below their 200-day moving average as a block. So that is a classic turning point. And there you go, just bouncing off it. Let's hope we stay in the blue and out of the red. Now, the interesting thing is whether these lower levels here, obviously we previously had high volume down here, it's whether we're running into buy volume or sell volume maximum. Certainly a change of hands was going on. And we've seen the data from prime brokerage, Goldman Sachs. A lot of that was hedge funds, just relieving people of the easy money. Again, intraday hit the 1.618 for the double correction, and closing prices were pretty much mid to closer to 1, in which case that is, that's a valid equal legs turning point consolidation. Wave 4, we can put that there, I think. It's held the 200-day moving average, obviously shot through the 50-day. So lots of interesting stuff in S&P. So that hopefully backs up again in the market. The underlying structure is at absolute extremes. We know that the VIX hit absolute extremes. Hard to return back. We'll look at that in a minute. Apologies, I haven't really looked at the Dow. Again, we were in place. We thought that we might have done enough. Like I remember saying, just slightly concerned as to whether that was a full 5 waves, or whether it was a 3 wave or not. At around the 1, looks like we consolidated and put in another 5 shorter there to get that as a double. In any case, let's have that as our 2 wave. So if we're right that is, all these things are bottoms, and that means by definition at some point there's a new high. I'm just not convinced completely, and we call it dead cat bounce, whatever you want to call it, is whether these things get back to 50% retracements or not. So yeah, 39,800 for the Dow. Again, that's there. That's a potential connector turning point. So let's keep our eyes on all these levels for when it turns or potentially turns. So they go down, double extension, looking for 39,800-ish. It's a potential resistance point. That lines up with the W bottom previously where we saw big support. Is that classic support resistance, blah, blah, blah. And it was also where we had a big downdraft on the way down. So highly likely there is resistance at that point. Again, we were talking about we needed a new high, or we were going to be doing extra consolidation. I think that has the classic look of, for the FTSE, classic look of the connector. So I said that these 2 days here had surprised me by the impulse, and they only managed to put in a 3-wave. So again, that looks classic for the equal legs again. Let's say that went to there. So yeah, we're in the zone. We just petered around with the one level into the one spot, 168. So it's all a case of it's there. I'm pretty sure that's a fall. Unlike the others where we had to bring down the peak, I think the FTSE has got more impulse left in it for sure into the rest of the year. So I'm sticking with a lower degree fall there. This will all happen over here. So does that mean that the value when it comes from the FTSE is going to go to a new all-time high? But it depends how this whole thing pans out. It has been a very quick hit down. There's a chance again that we get a 50% retrace of that, and we come back and test again, still within this zone before we go. I don't think FTSE will necessarily break away when the other indices are in risk off mode. So just like the others, we need to see what happens at 50% retracement. Ship was asking about Brent oil, etc. This was the point shift, 76.69. If that were to get taken out, then that looks pretty much like it's an impulsive move down. But look, we've got one we thought previous was a connector, we've had another 5 down, we've had an up and an ultimate impulsive new low. That looks like a connector there. So I'm looking for, probably now we need to be looking at double extension of that ultimate first move up to there. So again, a challenge of 71, 72, 71 before that even thinks about bouncing back. But because we're into that new low, we've been talking again, if it were to break, we have to talk about being into this being wave 2 top up here, and we're into wave 3. Now that's just going to have rallies and impulsive downsides, and we can keep seeing that it's starting to heat up in that regard. So potential for small bounces in oil as always around headlines, but because of demand destruction, very much looks like we're in the worst part of the oil makeup, that we're in a third wave all the way down. So I'll just finish off very quickly with the volatility indices. So they're all off the top. The bond index, that is staying elevated, not really from negative levels, because there is volatility through the curve. Some things are going up, some things are going down, blah, blah, blah. And that has started retracing a little bit. And then we've got the same with the VIX over here. Massive spike intraday, didn't really close above 40. We're messing around in the 30s, back into 20s today. And we know that Ultimately, that is our channel that we've been following, and we're not a million miles away from re-entering the channel, which is basically dog interruption. It's basically back into the sort of risk on mode. If we can get the VIX back in that 16 sub 16 channel, and we were complacently-ish, weren't we, trading here down at 12. So somewhere around 16 to 20 would be enough to calm things down, I think. That's it, really. So what does this mean for short-term Canadian strength? What from the oil side of things, or just in general? I think oil's dollar's a bit noisy. There's a bit of consolidation to come potentially, and then further downside. So net, I'd be expecting would Canada be outperforming. The problem is you've got Macklin talking about being the problem. Macklin wants to get rates coming off still, doesn't he? So, and he's happy about being divergent from the Fed. The last few days has caught up, but does that hold? So I reckon over the next few weeks, Canadian dollar probably outperforms. Yeah, I think I'd be with you on that. I'll have a look at that chart and come onto my chat with it. Good question. Any other questions from anybody? If not, I've got to go and do a few things. I think 2 hours is enough for anybody. Good stuff. Thanks for joining and thanks for your questions, guys. Good to see some new names, and we'll see you on. You're looking for you're waiting for the yield report. What's that? Thank you, Bletchley. Anyway, any more questions, just bang them on my chat and I'll come back to you later today. Brilliant. Thanks a lot, everyone. Bye.